Today, we are diving deep into the engine room of the global economy, the stock market. And look, let's forget the flashing tickers and the complicated charts for just a minute, because at their core, these markets are battlegrounds for incredible power. It's where the future of finance is literally being decided every single day. So we're going to figure out who's really at the top of this financial food chain and who's coming for the crown.
All right, here's how we're going to break it all down. First, we'll look at America's iron grip on the market, but also the paradox that lies right at its heart. Then, we'll jet over to Asia to see how state control is building a different kind of giant. After that, it's on to Europe and its big ambition to unify. Then we'll take a look at the high-risk, high-reward world of emerging markets. And finally, we'll look into the crystal ball at the digital future of the exchanges themselves. Let's get into it.
So to really get a handle on the world of finance, you have to start in one place, the United States. It is, without a doubt, the heavyweight champion of the world, and I really do mean heavyweight.
I mean, just look at this chart. It lays it all out, plain and simple. You see those two massive towers on the left? That's the Nasdaq and the New York Stock Exchange. They aren't just a little bit bigger than their competition in Shanghai or Japan. No, they are in a totally different universe. It is an absolutely staggering show of financial power.
$62.88 trillion. Just let that number sink in for a second. That is the combined value of just two American stock exchanges. To give you some perspective, that's more than the entire yearly economic output of China, Germany, Japan, and India, all added together. It's a concentration of wealth that's almost impossible to wrap your head around.
But here's the thing, when you build a skyscraper that tall, you have to wonder, what's the foundation look like? And this is where we get to the paradox. What is actually propping up this $62 trillion giant?
Well, would you believe it? The answer is just 5 companies. Microsoft, Apple, NVIDIA, Amazon, and Meta. A gigantic slice of that $62 trillion is basically riding on the fortunes of these few tech titans. Now, you don't have to be a financial genius to see that this is a huge concentration risk. If even one of these giants stumbles, the shockwave could be felt across the entire global market.
What's so fascinating, though, is that these two American behemoths are totally different beasts. You've got the NYSE, which is kind of like the old-school, prestigious country club. It's home to the big, established industrial firms, and it still has that iconic trading floor, even if it's mostly for show these days. And then you have the Nasdaq. It's the sleek, all-electronic upstart built for pure speed. It's the natural home for tech companies and fast-growing businesses.
And the U.S. is not sitting still either. This recent shift to something called T+1 settlement is a massive upgrade to the whole system's plumbing. You know, think of it like this. It's the difference between waiting 3 days for a bank transfer to clear and having it happen almost instantly. It makes the entire market faster, safer, and way more efficient. And you better believe every other country is watching this very closely.
Okay, now let's shift our focus and travel east, because there's a totally different kind of financial dragon waking up. Asia's markets are becoming enormous, but you know what? They're playing by a completely different set of rules.
This table right here captures the two sides of China's financial strategy perfectly. Over in Shanghai, you're looking at the core of the state-controlled economy. It's packed with massive government-owned companies, and it basically acts as a mirror for Beijing's national goals. But then you have Hong Kong. That's the open door, the bridge to the rest of the world, where global investors can get in on the action and really get a feel for China's economic pulse.
And this quote just hits the nail on the head. In the US, the market is the driving force. But in China, the state is the driving force. So what does that mean for an investor? Well, it means you're not just betting on a company, you're betting on the political and economic direction of an entire nation. That is a completely different ballgame.
And listen, Asia's power isn't just about stocks. Of course, you've got Japan, home to industrial titans like Toyota and Sony. But maybe even more important are China's commodity exchanges. The global price for iron ore, a fundamental building block of modern industry, isn't decided in New York or London. Nope, it's set in Dalian, China. Now that is some serious economic power.
All right, let's head over to Europe now. Financially, it's always been more of a patchwork quilt, a collection of powerful but separate national markets. And for a long time, that fragmentation has been a real weakness. But now, there's a huge, ambitious plan to stitch it all together.
And that plan is called the Capital Markets Union, or CMU. This is the European Union's big gambit to create a single, massive, integrated financial market. And the goal couldn't be clearer: build a European heavyweight that can truly compete toe-to-toe with the giants in the US and China.
And you know, this is where it gets really interesting. Because a modern stock exchange isn't what you think it is. It's less of a marketplace and more like a high-tech toll road. Just look at the revenue for Germany's exchange. The actual trading, that's less than half their business. The real money, the serious money, is in controlling all the infrastructure, the clearing, the settlement, and selling the incredibly valuable data that flows through their systems.
So, when it comes to adopting all this new technology, Europe's approach is basically measure twice, cut once. They are absolutely bringing in things like blockchain and AI, but they are doing it really carefully. There's a huge emphasis on testing everything to death and making sure it all lines up perfectly with regulations. It's a slow and steady approach for sure, one that puts stability above everything else.
Okay, now for something completely different. Let's venture into what you might call the Wild West of global finance, the emerging markets. This is where you find the biggest risks, but also, potentially, the biggest rewards. It's a high-stakes game for sure, but for investors who can stomach the volatility, the payoff could be huge.
So why all the excitement right now? Well, this chart tells you pretty much everything you need to know. After a really long time in the doldrums, emerging market stocks are basically on sale. Compared to US stocks, they are cheaper than they've been in 20 years. For investors who are hunting for a bargain, that is an irresistible siren song.
But of course, with that kind of opportunity comes a whole lot of risk. And that's why we're seeing a really smart new trend pop up. Investors are starting to use what's essentially a democracy filter. They're screening out companies based in politically unstable countries to try and weed out some of that risk. It's a clever way to navigate these often choppy waters. And if you want a perfect, almost unbelievable example of the kind of risks hiding in plain sight, just look at this. The Saudi stock market is worth over $2.5 trillion. It's huge, but here's the twist. 2/3 of that entire market is just one single company, the state-owned oil giant, Saudi Aramco. So in a very real way, the Saudi stock market is Saudi Aramco.
And this creates a massive headache for investors. The Saudi market is like having a priceless supercar that's permanently locked away in a garage. It has incredible value on paper, but you can't actually take it for a drive. Because the government owns so much of the market and so few shares are ever traded, it's incredibly hard for outside investors to buy or sell. So that multi-trillion-dollar valuation, in some ways, it's kind of an illusion.
All right, for our final chapter, let's look to the future. Because technology isn't just changing the market, it's ripping up the old rulebook and completely redefining what a stock exchange even is.
You know, stock exchanges used to be more like old-fashioned clubs, owned and operated by the people who traded on them. But then they started going public, becoming for-profit corporations. And that changed everything. Now we're in the middle of a full-blown arms race, with these massive corporate exchanges buying each other up in a frenzy to control the latest tech and the real lifeblood of modern finance: data.
And that leads us to the final multi-trillion-dollar question. When a stock exchange stops being a neutral playing field and becomes a for-profit tech giant, who is it really working for? Is it serving the public, who depends on it for a fair market, or is it serving its own shareholders who demand bigger and bigger profits? As these exchanges morph into tech and data behemoths, that's a question we're all going to have to think about.